The president re-upping his criticism of the Federal Reserve this morning in an interview with CNBC.
We should be entitled to have a fair playing field. But even without a fair playing field, because our Fed is very, very destructive to us, even without a fair playing field, we're winning because the tariffs are putting us at a tremendous competitive advantage.
Let's get over to the CME Group in Chicago. Rick Santelli with the Santelli Exchange. Good morning, Rick.
Good morning, Sarah. Boy, that one was teed up. We're going to have to deal with that. Listen, my guest today is Torsten Slok. He is the chief international economist and managing director of Deutsche Bank Securities, Inc. Torsten, thank you for joining me. And right off the bat, I will react, and I want you to react to that, what we just played. My answer would be the president has a lot of hyperbole, and I think he's the most transparent executive we've ever had. My saying to him would be, let's lower 275 basis points and join Europe. You think we're better off now? What's your comment?
Well, we tried negative interest rates in Europe and also in Japan. And honestly, it's not really working very well. There's a number of problems with negative interest rates, in particular in Europe. So from that perspective, lowering interest rates into deep negative is not helpful. Lowering into modestly positive would obviously be helpful, but the question is if that's needed or not.
Exactly, and that's where I really want to begin this discussion. Right now, all Fed futures are down just a little bit, but many still believe, if you look at distant contracts, a lot of easing's built in. Many say stocks easing built in. What do you say?
No, absolutely. If you look at this historically over the last 2 decades, you have seen that the market has actually consistently been wrong in predicting what the Fed will do. That doesn't mean that the market is always wrong and everyone is wrong. It just means that it's hard to predict the future. The Fed has also had a really hard time of predicting what they would do themselves with that dot chart. So the bottom line is that constantly we're hit by shocks, and the question is assessing the magnitude of these shocks is critical, and we just don't really know at this point if it's required to have deep cuts in rates as the market is pricing at the moment.
Yeah, I would urge President Trump to really study those that have followed his suggestion to the nth degree. We now have, according to your research, 11 trillion negative yielding bonds across the globe. That is not far from the high of 12 trillion with a T in 2016. How is this trend going to end, Torsten? How are they going to get out from under the weight of negative rates outside the U.S.?
Oh, this is really important because think about it. When you have negative interest rates in the euro area, when negative interest rates in Japan, it basically creates significant distortions in investor behavior. If you are a pension fund or insurance company in Europe or Japan, and you're looking at negative interest rates, you start to hunt yield in the US. And from that perspective, US 10-year rates actually look a little bit juicy. There are some issues about hedging costs that have been going a little bit up, and now they're going a little bit down. But the bottom line is the hunt for yield into US markets has been enormous as a result of that 11 trillion negative yielding debt that you're mentioning. So this is a very significant issue, and it's hard to get out of, as you're saying, Rick. It really is a difficult challenge.
All right, in the small time we have left, we had the jobs report on Friday. Parts of it were disappointing. You've talked about how we see an early trend that total labor income is starting to slow. What does that say in your mind about consumer spending trends?
Yeah, that's right. If you add up together and look at that, wages have been slowing modestly, employment growth has been slowing modestly, hours worked were unchanged. Adding all that together basically shows you the labor income, meaning how much income do workers get to go and shop in stores and in warehouses and online. And that's actually beginning to slow modestly. So we're getting a little bit worried that the labor market is not as tight as it used to be. And that might mean a little bit of a slowdown in consumption. On top, of course, of all the worries we have about uncertainty from the trade war weighing on capex. So the broader GDP outlook is probably for growth slowing modestly here again going forward.